Hi there, this is Bob Graham from Riggs Asset Management Company. Today we want to do an update on the markets. We're coming close to the end of the quarter, and as you know from looking at your statements, your portfolios are doing really well this year. And the entire Riggs team and the Riggs family are really proud of what we've accomplished and how well we're doing simply across the board. Whether we talk about the bond portfolios, the equity portfolios, the balance of the two, it's been a really good year for the Riggs family. Anyway, having said that, we've had some pretty big changes recently. Yesterday, the Federal Reserve began to cut interest rates again. When we look out there, we think we probably are going to see them cut rates as much as 0.75 of a percentage point to a 4 percentage point over, let's say, the next several months going into early 2026. And we get this by simply following what's happening in the bond market, by looking at what's happening in 2-year treasuries. As I've said before, the Federal Reserve tends to follow the action of the 2-year treasury, and we'll put a chart up to show that. And you can see that, it's pretty true. If the 2-year treasury moves lower, the Fed funds tends to follow. And right now it's calling for about 100 basis points to 75 basis points of decline in interest rates. Why are they doing that? Well, they're doing that because the employment rate's slowing down. We've literally seen payrolls over the last 4 years, or the amount of new jobs, if you will, decline steadily. And it's gotten to the point where they had to react. And so, whether they're late, whether they're early, they're at a point where they simply have to react. And I think we're going to see rates come down in a relatively quick manner. So what does that mean for the markets, and what does that mean for the economy? Well, for the bond market, it's a huge plus. As you know, when interest rates come down, bond prices go up. If bond prices go up, that means that fixed income portfolios move up in value. And I think we're going to see that. And we've actually adjusted the portfolios in anticipation of this process beginning to take advantage of it. So I think you're going to see your bond portfolios do very, very well over the next several months because of the way we positioned in anticipation of this move. For the economy, well, if you have to borrow money to buy a car, buy a house, or buy anything, buy plant, buy equipment, a tractor, what have you, being able to borrow that money at a cheaper rate is better. So lower interest rates in general term will tend to help the economy. And I think we'll see that. And we'll see that, affect the housing market. I think we'll see that affect, the auto market. I think we'll see that affect cyclical industries such as banks, financial companies, heavy industrials. So I think across the board, that's going to be a positive for all these companies within the economy and individual borrowers out there. For the equity markets, well, lower interest rates tend to boost equity prices. So we think the rally in the stock market is going to continue. I think it's going to be bumpy. Coming in the fall, you tend to get pullbacks. Our expectation is we're going to have pullbacks. They should be shallow, and if anything, buying opportunity. But the way we're positioned, we think we're actually positioned to take advantage of that. Some of the areas we're invested in, whether it's artificial intelligence, whether it's infrastructure, whether it's the building out of the energy complex and the demand for electricity, these things are not going away. And even in a slight slowdown, we'll do extremely well because you have to build out the AI systems. And if you're going to build out the AI systems, the one thing you need is massive amounts of energy. And so you got to build out the energy systems to drive the electricity. And so what we see is an environment where bond prices should be moving higher. We're going to have a little bit bumpy, but stock prices are going to move higher. And we think we're in a really sweet spot for the equity and the bond markets over the next several months. So anyway, if you have any questions about this or want to go into more detail about what's going on in the market and what the drivers are, reach out to your Riggs team. We're here to help you and answer any of those questions you may have. Also, if you have a personal financial question or just want to better understand what's going on in the economy and the markets, give us a call. We're here to help you in any way we can. I hope you found this helpful, and I look forward to talking with you again. Thank you very much.